All right, let's get right into it. Over the weekend, the U.S. and Israel launched massive decapitation strikes across Iran. This is your urgent briefing for what you need to know before that opening bell.
So, with Iran's supreme leader now presumed dead and military sites hit in 24 provinces, the Middle East is staring over the edge of a cliff. You better believe institutional desks are preparing for a massive risk-off environment. So let's break down exactly how this geopolitical rupture is going to hit your portfolio.
First up, the most immediate, the most obvious shockwave is hitting the energy markets. The entire game for global oil supply has just changed, and it all starts in one very narrow, very critical stretch of water.
Iran's Revolutionary Guard has been broadcasting warnings to all commercial ships. The Strait of Hormuz is closed. And this wasn't some idle threat. The effect was instant. We're talking about major trading houses suspending all shipments, and we have confirmation that oil tankers are literally making U-turns in the Gulf of Oman as we speak.
So, what does this all mean for the price? Well, Brent crude closed Friday at around $73 a barrel, but analysts are warning of an immediate $5 to $10 gap up right at the open. And if this shutdown continues, we are looking at $100 a barrel, and I mean fast.
And this is where things get really hairy. This highlights the tail risk. In a full-blown war scenario, which we can't ignore anymore, analysts are modeling sustained prices between $150 and $180, with the potential for pure panic spikes to clear $200 a barrel.
But there is one major counterweight that traders are watching, and honestly, it could be the most important headline of the day. All eyes are on the emergency OPEC Plus meeting that is happening right now. This is the magic number, 548,000. Word on the street is that OPEC Plus is thinking about a massive emergency production hike, up to 548,000 barrels a day, just to calm the markets. Whatever they decide to do is going to dictate how severe this oil shock really gets.
Okay, let's pivot. Let's talk about the one sector that is set to absolutely surge while pretty much everything else bleeds. While the rest of the market goes risk-off, a massive rotation of capital is already getting underway.
You know, this trend isn't exactly new, but this weekend's events just poured rocket fuel on the fire. This defense supercycle, and just look at the S&P Aerospace and Defense Index, it's already up 17% this year, is being driven by this new era of global instability and, of course, a proposed $1.5 trillion U.S. defense budget for 2027.
So here are the names you got to watch. You've got your prime contractors like Lockheed Martin and RTX. They historically pop on U.S. Iran tensions because demand for missile defense just skyrockets. Over in Europe, names like Rheinmetall and Saab are already up over 20% this year. But you also got to look at the subsystem guys like L3 Harris and pay very close attention to Kratos. They just priced a $1.2 billion stock offering to go all in on scaling their unmanned systems. And those are in very, very high demand right now.
When the missiles start flying, capital runs for safety. It always does. But this weekend gave us a masterclass in what a true safe haven is and what it absolutely is not.
The market has spoken loud and clear. It's drawing a hard line in the sand. On one side, you've got your traditional time-tested safe havens, and on the other, you've got the assets that were sold as a hedge but are behaving just like another risky tech stock.
The numbers don't lie. Gold, which was already up 22% this year, is seeing a huge rush of inflows, trading around $5,300 an ounce. Silver is pushing past $93, and you know traders are now aiming for that massive $100 psychological mark. And in the currency markets, money is flooding into the US dollar and the Swiss franc. And if you want to see a stark contrast, just look at the currencies at the heart of the conflict. The Iranian rial has completely collapsed, losing 30% of its value to hit a mind-boggling 1.7 million per US dollar. Meanwhile, the Israeli shekel is facing some serious and lasting pressure.
So this weekend just shattered the whole digital gold thesis for crypto. Bitcoin didn't act like a hedge. It tanked over 2%, down into the 63,000 range. Ethereum and Solana got hammered, dropping nearly 10% as panicked investors just dumped them. The takeaway here is crystal clear. In a real-world crisis, crypto behaved just like a high-risk asset, draining your liquidity instead of protecting it.
All right, let's zoom out a bit and see how this is probably going to play out across the general market, because there are some very specific sectors and indices that are looking incredibly vulnerable right now.
Expect pain at the open. U.S. futures are already pointing to a big gap down across the board. The damage is global, too. Gulf markets in Saudi Arabia and Dubai are looking at a 3 to 5% drop. And over in India, everyone's watching the Nifty 50's critical 25,000 support level.
And of course, the most obvious victims here are the airlines and logistics companies. They're getting hammered by airspace closures and the fact that any hope of returning to the Red Sea is now completely off the table.
So, with all that said, what do you actually do when the market opens? Let's boil this all down to a clear, actionable game plan based on what the pros are saying.
Okay, step 1. Preserve your liquidity. Cash is king. Volatility is going to be insane. Step 2, and this is crucial, avoid the opening trap. Do not blindly buy the dip right at the bell. Step 3, watch OPEC+. That announcement is the single most important signal for where the market goes next. And finally, step 4, if you have to make a move, position defensively. Think about the sectors we've talked about: energy, defense, and precious metals.
Look, the market landscape was fundamentally redrawn in just 48 hours. The first shockwave is hitting us right now, but the aftershocks could last for months. So the real question you have to ask yourself is, how are you positioned for what comes next?